Bollinger Bands operate in a similar way to envelopes, except that in this case the envelopes or bands are calculated using standard deviations. For those of you who, like me, are not mathematically oriented, what that basically means is that the bands contract or expand depending on the level of volatility. The greater the volatility, the wider the bands, and vice versa. The first requirement in plotting a Bollinger Band is a time span, as with a moving average. The longer the span, the smoother, less sensitive are the fluctuations. This hourly chart of the iShares Lehman 20-year Trust ETF, the TLT, plots the bands with the standard or default time span of 20 periods in the top panel, with a default deviation of 2. On the other hand, just to show what a difference a change in the parameter can make, the lower window shows an upper band with a 60-period time span, again with a deviation of 2. It's pretty obvious that the 60-bar span is far smoother and is plotted further away from the price action. The second parameter for plotting a Bollinger Band is the amount of deviation. In this respect, the bands in the upper window of this chart are calculated with a value of 4, whereas the deviation in the lower one has a deviation of 1. This results in a very tight band, which is touched so many times it's really not very useful. Alternatively, the larger deviation factor returns in the upper panel a band that's a long way from the price and is rarely if ever touched. Again, pretty useless from an analytical point of view. Think of the deviation as a parameter that corresponds with an overbought oversold level. John Bollinger, the creator of this technique, recommends a factor of 20 for the time span and 2 for the deviation. Those are the parameters I'll be using for the remainder of the charts in this presentation. Rule 1. When the bands narrow, there's a tendency for a sharp price change to follow. In this context, a narrowing of the band is always relative to the recent past. A couple of good examples are flagged in this chart of hourly progress in the iShares Lehman 20-year Trust ETF in August of 2011. Both instances were followed by a strong rally. Note how it was possible to confirm the widening of the bands with some nice trendline breaks, which both provided timely places to get on board. This approach will usually work pretty well and pretty reliably, but this mid-July breakout did not. See how the confirmation was followed by a very small advance, which suddenly turned to dust. That's why you should always have an exit strategy prior to entering any position. In this case, the logical stop place would have been a drop below this red uptrend line. A small loss would have been realized, but the major drop would have been avoided. Here's another example of a narrowing band situation. It was confirmed with this trendline break. Note that the line is violated before the price touches the upper band, so a move through the band is not a requirement. There's no way of knowing that the advance will be quite so strong, but quite often when you get a tight balance between buyers and sellers, this is what results. Finally, here we see the bands narrow significantly, and the price breaks out of what is the neckline of a consolidation reverse head and shoulders. Being good risk managers, we need to have an exit point, just in case things go against us, and that would be just below this red support trend line. Now let's see what happened. The band certainly did expand, but for a downside move. You can appreciate how lots of money can be lost extremely quickly if you don't place a stop ahead of time. Rule 2. If the price exceeds a band, the trend is expected to continue. This is really another way of saying that if the price moves above the band, upside momentum is strong enough to support higher ultimate prices, and vice versa. In this chart of eBay, you can see that the bands narrow, and a trend line is violated, and a rally transpires. Nothing special here. However, the signal that the trend will continue comes from the point where the price exceeds the band on the upside. Generally speaking, a price break above the upper band or below the lower band following a trading range or a sharp decline or rally is a signal that the price probably has sufficient momentum for the trend to continue. The crossover of the Bollinger Band usually indicates short-term exhaustion, and it quickly pulls back again. However, this is just a pause for breath until the trend is able to extend again, taking the price back above the upper band. Later on we see another break above the band and a pullback below it, all in an ongoing rally. Finally, another move above the band, but this time the price is exhausted, and that's the top of the rally. By now you'll have noticed that the price often crosses the band several times before the trend reverses. The obvious question at this point is, how do you know when the band has been crossed for the last time? In other words, how do you know how to spot a bottom and top of a move? And the answer lies in Rule 3. Rule 3. When the price traces out a reversal formation, after it has crossed outside a band, expect a trend reversal. In this intraday chart for the NYSE Composite, we see a series of 3 rallies that touch or exceed the upper band. The first 2 show no sign of exhaustion. However, after the final attempt, this red uptrend line is violated. Then the price falls below the previous minor low to complete a small top at that point. Later, the price touches the outer band again but fails to move through it. It does rally, but this advance is contained within the band. Later it traces out a trading range. If the price had broken below the lower level of that range, we would have seen a sell signal, but it did not, and the advance resumed. Finally, a nice uptrend line is violated, and a sell signal is triggered just here. What we're seeing is a series of overbought readings, which is what a price touching the band really is. It finally confirms the overbought reading. If there's no signal, the implication is that following a brief correction, the price will then go on to register a new high or low for the move, depending on its direction. The final event on this chart is the narrowing of the band and price break above this horizontal trend line. Note the violation of the upper band, which indicated substantial upside momentum. Little wonder that we subsequently saw substantially higher prices in short order. Here the price crosses below the upper band, yet it does not go on to make a new high until a worthwhile decline has taken place, and there are no technical events such as a trendline violation or a price pattern completion to use as an exit point. In such instances, the best place to liquidate a long position is where the price crosses below the moving average. Later on you can see a small double top as the price tries for a second time to break above the band. At the next attempt there's another double top and a more serious signal as the price violates this uptrend line. Then we see a trading range, but the lower end is not broken, so there was no reason to sell. Finally, the price tries to break out of the trading range but is held back by the upper band. A subsequent trendline break is a signal to liquidate. This chart of Amazon, based on 30-minute closes, offer a number of Bollinger events. It's almost like 1, 2, 3. As first, we see the narrowing of the bands indicating a fine balance between buyers and sellers. Second, confirmation that the battle has been won by the buyers as the price breaks above this green trend line. And third, confirmation not only that prices are going up, but probably at a fast clip as the price moves through the upper band. After touching the upper band a couple of times, the price moves sideways and confirms that the move is probably over, as it breaks below the red support trend line. Later on we see the bands narrow again. Second, a break above the green trend line, and third, the break above the upper trend line, and we're off to the races. Perhaps a great place to end our explanation of Bollinger Bands. Summary of Bollinger Bands. 1. When Bollinger Bands narrow, the subsequent widening of the bands is often followed by a sharp price move. 2. When the price breaks through one of the bands, this is a sign of strong momentum, and we should expect the trend to continue. And 3. When the price returns through the band, expect a pause in the trend unless this crossover is associated with a trend line break, in which case the crossover probably represents exhaustion. Well, that wraps up our intermediate module. I hope you've enjoyed it. Don't forget to try the quiz, which will give you a good idea of what you have and have not learned. Never be afraid to go back and watch this presentation again. There was a lot to take in for just one session.